We are moving towards being overweight global equities. We want to do that early in the new year. We're looking selectively at this point, but there's so much technically driven and sentiment driven selling going on right now that and lack of liquidity that we very much want to be cautious between now and the end of the year.
When you say global, does that include the United States, or is that everybody but the United States?
It does now. And the last time I was on, we were saying, shift overseas. The U.S. was the best performing investment category. That was November. U.S. was flat. Everything else was down. Guess what?
The U.S. caught up to everybody else?
In some cases.
Yeah.
And EM and some of the, other areas overseas have actually kind of caught up to the U.S., especially on the currency, on the debt side. So we're now including U.S. as being, part of the opportunity set because we really think markets have gone too far in re-rating global growth and reassessing global liquidity.
So you are right now neutral or on your way to overweight or underweight on your way to overweight?
So we've been neutral in the U.S. Our overweights have been in select emerging markets. We are moving to an overweight broadly, with the exception of Europe, where we're remaining neutral, just while we work through some of the near-term political risks.
Mohamed, I want to go back to something you talked about at the top of the 7 o'clock hour, and that's just your idea that maybe this has been overdone to some extent based on a re-evaluation. It's kind of what Tepper told you yesterday, Joe. Just at this point, the tide's going out. All this liquidity that we've been awash in. The reason to buy on the way up was because it was coming in. Now it's heading out. What do you think about the latest moves, though? Is this an overdone situation?
So I agree with Erik that this is a technically driven sell-off. Having said that, I have seen technically driven sell-offs overshoot by quite a bit. So that's really important to remember. What seems irrational to people out there is not at all irrational. It's money coming out of the asset class. It's people repositioning. It's people saying it's about preservation of capital, the return of my capital, not on my capital. So first thing is, don't underestimate the extent to which technicals can dislocate markets. The second thing is this is really interesting because the big risk is that technicals contaminate economics. It goes through business sentiments. It goes through consumer sentiment. Don't underestimate that risk. Having said that, I worry about the trade, the rest of the world versus the U.S. I think that in a downturn, the U.S. has much better shock absorbers than the rest of the world. And EM, really? I mean, high yield in the U.S. is cheap relative to EM today. So one has to be really careful about how to navigate this. So Erik, the big question I would ask you is, what are clients telling you? Are clients saying, yes, I am confident, go overweight, I'm giving you more money? Or are they saying, I don't know, let me take some money out? Because that is going to be really important from here. Yeah,
on the institutional side, investors are thinking longer term. They're able to take a longer term view. So it's a lot of questions. And and the key question is, where are we in the cycle and what are the odds or what's the probability of recession in the next 12 months? If you condition corrections like we're in the midst of right now, by subsequent growth over the next 12 months, whether it's looking at PMIs or looking at whether we go into recession, that toggle switch leads to very different outcomes. So if we do not go into a recession in the next 12 to 18 months, if PMIs stay above 53, for example, which they are in the U.S., although the most recent data looks more concerning, historically markets have rebounded. And I think, in our view, that's our base case, is that we're not going to go into recession in the next 12 to 18 months, although our concern would be really that the technicals kind of become prophecy because they lead to a self-fulfilling situation of lack of confidence. But when we look at our expectations of growth in the U.S. going from 3.5 to 2, China's going to spend at least a couple % of their GDP to stimulate there. If the Fed is going to be truly data-driven on their next steps, they'll pause for a significant period of time. That means normalization as opposed to recession.
James, what does the economy really look like right now? And is it a concern of yours that what's happening in the markets actually create prophecy when it comes to the economy?
Well, we do think some of the volatility we're seeing does create opportunity, especially amongst global markets. I think the perspective to take here, we work with very long-term investors, is that over the last 2 years, we've, in some sense, seen kind of this mini cycle. Last year, the markets were trading as if nothing could ever go wrong. You had economic growth chugging on all cylinders across the world. You had earnings growth that was spectacular last year and this year, coming out of an earnings recession. And this year, the market's trading as if nothing will ever be right again. And clearly, it's going to be somewhere in the middle. over the long run, the market, we already know, can only sustain about 5 to 7% long-run returns on average per year because of the way economic growth looks and the way that earnings growth looks. So we think the market is somewhat too pessimistic here, but we're not being dismissive of the volatility. Like Mohamed said, technicals can very much overshoot. The trouble right now is simply that, over the long run, especially over the next 12 to 24 months, we think that the market has probably very far overshot already where the fundamentals are.
Overshot to the upside, you mean?
Oh, overshot to the downside.
Yeah.
Downside, absolutely. Yeah. I mean, you look at the indicators that people are talking about, things like the yield curve slightly inverting. It hasn't fully inverted. Typically, there's a process before you get to the end of the cycle, and ultimately, earnings growth is still going to be positive next year, somewhere around 6 or 7%. It's not going to be negative, and that could still drive earnings, still drive returns.